up everybody, good day to you all ladies and gents. Welcome back to Matrish Investing, the #1 YouTube channel that is dedicated towards giving you education based on investing in capital markets. Now in this video we're going to look at the statement of changes in equity as well as the factors that influence such change. Now if this is the very first time you're watching our videos, we advise you to check out our previous videos so that you can have a better understanding of what exactly we're teaching. If you also find this video helpful, by all means please help us out by liking this video, subscribing to our channel if you haven't, and click that notification bell so that YouTube gets to notify you each time we get to upload videos into the platform. Now with that said, ladies and gents, let's get down to business. So what is the statement of changes in equity? Now this is a financial statement that is prepared by the business to show changes in share capital, reserves, and retained earnings in a specific period of time. Now if you watched the video that was talking about the statement of financial position, we saw how a business has assets, liabilities, and shareholders equity, or aka capital. Now in the shareholders equity, we saw how there's different components that make up the shareholders equity. There's share capital, there's reserves, there's retained earnings, there's share premium, and all that stuff. So basically there's another statement that is dedicated towards providing more information or more specific information about the shareholders equity, and particularly the change in their valuation. So this capital or this shareholders equity, all those components tend to change in value from time to time. Now it is because of that there came a need to prepare a financial statement that is dedicated towards explaining and showing out the transactions or the reasons behind the increase or the decrease in that particular component of the shareholders equity. Now the statement of changes in equity separates the components of capital, like it shows each and every single component individually, and shows the reason that led to the change, that is the increase or decrease in value of each specific component in the time period that has been covered by the business. So then it separates all those components of equity. So then it will show share capital as share capital, retained earnings as retained earnings, and all those other components individually. It will show their valuations at the start of the financial period, or the start of when this statement of changes in equity is covering. It will show all the transactions or all the processes that had happened during that time period, and the end result, the end value, the balance at the end of that financial statement, like basically the amount that has been recorded at the end of what the time period that financial statement is supposed to cover. So then that is basically everything about the statement of changes in equity. Now we need to understand, we need to kind of get into realization, we need to understand some of the most common reasons that result into the change in shareholders equity. So then let's get on to it. So reasons that result into the change in components of equity. Reason number one, the recording of net profit or loss in the year. So then once a business does its main activity and it's able to generate an amount of profit or loss from such activities, then the amount is added if profits, or deducted if loss from the retained earnings. So we all remember net profits and loss. We covered this in the income statement, the video that talks about the income statement. So basically once a business does all its activities, its main activities, its side activities, all of which result into the creation of revenue, paying down expenses, and all of which will help us realize what the bottom line figure will be, as to whether it will be a profit or a loss. So then that amount of money that is realized after paying down all the expenses using the money obtained from revenue, that money attained, if profit, it is added to the shareholders equity under the category of retained earnings. So then this shows reinvesting of profits back into the business. So then once a business has profits and those profits are recorded in the retained earnings, that just shows a reinvestment of profits back into the business. But then however, if there is a loss, meaning that there is a certain amount of money that the business still has to pay up, there is expenses that haven't been fully funded by the business, that is the negative figure itself indicates that this business is in debt and still has to pay out some expenses. So then if the business has recorded a loss, then the business will have to go down to the retained earnings. It's going to have to pull out some cash to cover or clear off that debt. So then that's why if it's a loss, it is deducted from the retained earnings. Now, there's the payment of dividends. So when a business decides to pay dividends to its investors, then in most cases the cash to be paid as dividends is deducted from the retained earnings. So then, leaving aside the whole process of reinvesting profits into the business, the retained earnings itself is also a source for payment of dividends to investors. So like in most cases, most people tend to see it as dividends are actually attained from the profits that have been made in the year. So then that is what is mostly the concern. That is the most concern to most people. But then in reality, if you're to ever look into it, or if you're to ever research about it, it kind of doesn't make much sense as to when, if you're to take out the dividend payments and compare it to the profits that have been made, the profits themselves, the dividend could like cover say 80 to 90% of the profits, leaving a mere, let's say, 20 to 10% as for reinvestment. So then that's pretty much, dividend payments are pretty much huge figures, or they take a huge portion of the profits. So then it will make much more sense to say that the payment of dividends comes from the retained earnings. Now, the retained earnings is an accumulation of profits that have been made by the business throughout its years. So then that accumulation, now if you take out a certain amount, a fixed amount of money as dividend payments, then comparing that amount of money to the actual retained earnings, the proportion that was taken out is kind of small, and it is much more realistic. I mean, if a business were to pay so much cash as dividends, and the business would have very little, the business will have therefore very little capital to run down the business. So then, in most cases, dividend payments are deducted from the retained earnings. Now, checking out component number 3, which is the comprehensive income or expenses. Now, this revenue or expense is a result of changes in equity of the business, non-related to investors. Now, we've already covered this in the video concerning the income statement and other comprehensive income. Now, if it is income that is recorded, then it is added to the retained earnings of the business. But if it is expenses that is recorded, then it is deducted from the retained earnings. So then the comprehensive income or expenses pretty much works kind of similar way with the net profit or loss of the year. So then if the capital that has been used by the business in other operations, if that had resulted into an increase in valuation, then that increase in valuation is recorded in the retained earnings. It's added back into the retained earnings. But then if there was a loss in such capital due to fluctuations in equity, then that deduction or that loss in value is then therefore deducted from the retained earnings. So increase or decrease in reserves. Now I believe we will remember what reserves is. We talked about it in the video concerning the statement of financial position. Now the reserves is basically the amount of money that is set aside by the business to cater for unforeseen challenges that could negatively impact the business. Now an amount of money that could be increased in the reserve for the purpose of increasing the amount of money to be available to solve any sort of problems that could pop up. Or an amount of money could be reduced from the balance to solve a problem that is already troubling the business. So then when there is an increase in reserves, then this just means there's a certain amount of money that has been set aside to increase the amount of money that should be there for reserves. So basically this is the business just cashing up or armoring up its reserves so that in case whatsoever challenge happens at whatsoever time expected, the business will therefore have larger reserves, or will have larger amount of money that is there waiting to deal with such a problem, or that is there to better solve that problem, and as a result will not hurt the normal business operations. While a decrease in reserves pretty much just shows that there's already a challenge or there's already a significant trouble, and for that business to solve that particular trouble, it has to go into the reserve that has been set there for that particular trouble. So then they'll withdraw a certain amount of money depending on the level of that challenge. So then they'll withdraw that amount of money to cater or to solve that problem. So then a decrease in value of reserves pretty much shows that a business has spent money to cater or deal with that particular challenge. Now, the other reason is change in accounting policies. Now, financial statements are prepared following some specific accounting policies. These policies affect the way business is supposed to represent revenues, expenses, assets, liabilities, or the capital itself in the financial statements. Therefore, by changing accounting policies, the value of increase is more likely to the value of equity is more likely to increase or decrease depending on how the policy works. So we'll understand that business financial statements prepared by the business, particularly these large ones, these public limited companies, they have to follow a few sets of rules and guidelines when preparing these financial statements. Basically, these are called accounting policies. So then these accounting policies are set by a board of accountants. They're set by significant organizations that are meant to do with accounting. Now, when these particular policies tend to change from time to time. They change from time to time either to go with the current trend or to go with the way the world works lately, like to stick up to date. Maybe some of the policies reflected a wrong logic, so then they have to correct that. Maybe the policies are also made to prevent a business from over recording, like from showing larger profits than what is realistically supposed to be there. So basically, these policies are there to show some sense of reality, some sense of truth in the financial statement. That's why these accounting policies are there. So then these accounting policies, the changes that are made, so then when there are new accounting policies and the business decides to change its accounting policies and adopt these new ones, then there's a more likely chance that there could be an increase or a decrease in equity, depending on what the policy is most likely to affect. So then it might not even affect the equity, but then there are policies that would directly affect the equity, and as a result, they would force a business to present equity in another way. There's some valuations that are supposed to be put, or there's some valuations that are supposed to be ignored. So then all of this will result into the equity increasing in value or decreasing in value, so that the equity is put up in a more realistic way. So then that is basically everything about changes in accounting policies in a nutshell. Sixth point is issuing of shares. When a business sells its shares in order to raise funds, the capital that enters the business brings about an increase in share capital. Well, this one is pretty obvious. You know, like how a business goes into the stock market, we've already talked about this, and it has to issue shares in order to raise capital. So then once that capital is raised, that amount of money is an increase in value, and that increase in value as a result of selling shares to investors. So then that capital attained is put in the category of the share capital. Then there is stock repurchase. Now, stock repurchase is basically the opposite of issuing of shares. Now, in this, a business buys back its shares from investors, and the result of buying back shares is depleting in capital, since that amount of capital has been paid back to investors. So basically, this, like I told you, it's the opposite, or it's the reverse of issuing of shares. Now, stock repurchase is basically the business deciding to buy back its shares from investors. So when a business buys shares from investors, it has to pay the investors money. Now that money that it pays the investors is basically capital. So then it's paying back capital. Now the reason why a business would do stock repurchase is, remember the meaning of shares. Shares is a unit of ownership. That's right. So then a business would therefore purchase back its shares or purchase back stock so that it can increase its ownership, also that it can have an increased ownership in the business, which means that as far as decision making is concerned, or as far as voting is concerned, the business itself will have a significant amount of influence and a significant amount of ownership, therefore having a very influential decision making upon everything related to the business. So then the business will be in a better stance to make decisions as compared to other investors. And finally, the last reason we're going to talk about is the correction of errors that have resulted in preparing components of capital. So when preparing components of capital, there could be some mistakes that have been made in the preparation of such components. There could be some errors that were made, like, hey man, some people ain't perfect, so then these mistakes tend to happen, these flaws tend to happen. Therefore, such errors are adjusted through the statement of changes in equity. So then, referring back to the components of capital, now if there was any errors that was made when preparing these components of capital, so then if this error had caused a decrease or an increase in value, then that particular value, that missing value, is therefore added back into the capital if it had been decreased, or is deducted from the component of capital if it had been an overstatement or if it had been an unnecessary increase. Therefore, correcting these components of capital to give a much more realistic, or to give a realistic value of the components of capital that are to be presented in the business. So then let's check out an example of a statement of changes in equity. So then here's an example of a consolidated statement of changes in equity prepared by the NMB Bank as of the year ended 31st December 2018. So then this consolidated statement of changes in equity covers up for a period starting from 1st January 2018 to the 31st of December 2018. Now there's just a few things I would like to state out here. So then as you can see, you see the title Consolidated Statement of Changes in Equity, and then there is Bank Statement of Changes in Equity right here. And these are two totally different statement of changes in equity. Now the ones we're looking at is the Consolidated Statement of Changes in Equity. Or in some other banks, or in some other businesses, you could see there is group, or they would show like a group. They would show financial statement for a group, and they would show financial statements for an individual company. Now, I highly advise that we check out the one for group, and as for this case, we check out the consolidated, because usually these businesses that are listed in the stock exchange, they're usually a group business, like concerning all those subsidiaries that are being held. Or when you say consolidated, then this means every single business that has something to do with NMB. So then we'll tend to look at consolidated. So then like I told you, in most cases, these businesses aren't usually individual subsidiaries walking into the stock market. They're usually businesses like a group, NMB group, KCB group, NMB consolidated, like comprising of all those other subsidiaries. Now, let's get down to it. Here are some of the components. As you can see, they're all separated. They're shown on individual basis, and they're in millions. We probably know what that means. So then we can see here, there's like as of 31st December 2017, those changes on initial application of IFRS 9. Now you can always check this out in notes. Like here they've indicated it's note 2, but then I could just tell you that this is a change in accounting policy. Like IFRS is basically accounting policies that deal with how financial statements are supposed to be recorded and presented. So then we can always check that out in the notes to financial statements. So then there is the opening balance right there at 1st January 2018. Then there's all these transactions that have happened for individual components of capital, all of which we can see have either increased or decreased the components up till the closing balance of 31st December 2018. Now we can see all that capital, the total amount of capital, and then there is non-controlling interest, and finally total equity. The one that concerns us is that total figure. Now there is total plus non-controlling interest, which leads to total equity. The one that concerns us is the total. So then what is the non-controlling interest? Now the non-controlling interest is basically, I'm going to give you a scenario. So then, as we all understand, these businesses tend to have subsidiaries. Now in those particular subsidiaries, in some cases it might happen that these parent businesses or these parent companies do not have a 100% ownership into these subsidiaries. So then there's a part ownership. There's another entity, there's another person or a business that has ownership into one of those or some of those or most of those subsidiaries. However, this particular entity has a less than 50% ownership into such subsidiaries, meaning that they do not have decision-making power in such subsidiaries. So, but then, however, they are still entitled to whatsoever profits made, or their capital still has to be recognized in the parent's company, financial statements. So the non-controlling interest is basically owners of little subsidiaries, or like owners with little ownership in the business's subsidiaries. So then that has nothing to do with us. We're the main investors. So then that total figure right there involves us. So then this is basically it. This is an example of a statement of changes in equity. I believe we all seen and understand how it works. So then with that said, everybody, thank you so much for watching this video. If this video has been a blessing to you all, please help us out by liking this video, subscribing to the channel if you haven't, and hitting that notification bell so our YouTube gets to notify you each time we get to upload videos into the platform. Now if you're also on other social media channels such as Instagram, Facebook, and Twitter, you can also check us out there in our page name, Matrix Investing. We upload content on a day-to-day basis. So then each and every single day you might get new tips, new facts, new knowledge or basing or regarding the capital market as far as Tanzania is concerned. But then if you also have questions to ask us, if you have questions regarding to investing in capital markets, feel free to ask. You can ask through our social